sides to a really great financial future. Tom and Don are talking real money.
One of Tom's favorite adages in the wonderful, wacky world of money is only buy the stocks that go up. Only buy the good ones. And boy, many of you tend to still follow that silly adage. You want to buy what's hot. Of course you do, because the hot things are the ones that make money. So how do you know what's hot? Well, your version seems intuitive, but it's really pretty much counterintuitive. Buying the things that have gone up means you're late to the party. The trick is to buy the things that are going to go up before they go up, but there's a problem with that. You don't know which ones they're going to be. So, does it make sense to buy what's hot? Jason Zweig, our buddy over at the Wall Street Journal, looked into this not too long ago, and he came to a conclusion that I think you'll find sensible.
This is a topic that we have covered several times. What we're talking about is what they call the gap, the behavior gap. Mind the gap. Isn't that what they say when you get on the subway or in the tunnel?
That's the underground tunnel in England.
Yeah, the underground. Yeah. So, and this is again, and this comes to mind, I think, for Jason because. Just another example right in everybody's face that I hope will wake you up and help you from making the same mistake. And it just turns out that and I'm going to use huge air quotes here, that the investment, which I don't think it is an investment, I think it's a pure speculation, is in Bitcoin. And they've gone back and looked.
Oh, you're going to do it again.
But that's
you're
the
gonna
thing. It's not necessarily about Bitcoin.
You're okay, but it doesn't matter. You said the word.
Here come the love
Now
calls,
the reviews come in.
Letters.
You guys just don't get it. Yeah. I'm sorry. This is not us. This is Jason Zweig at the Wall Street Journal, dudes.
Yeah, and he makes it. I love this line. He says, investors keep chasing performance, but they never seem to catch it. And then he later says, they pursue pleasure and flee pain. Well, don't we all do that? I mean, that's a no-brainer. But so they will go back and look at the actual performance of investors, not when you look at a fund that says, we make 12% a year. How much do the investors actually make?
This is the number that a lot of people have been looking at. It's called investor returns. Morningstar has used these numbers. Dalbar?
Yeah,
Dalbar was
Dalbar,
famous for this. It's the difference between what the investments themselves make and what you make because of your behavior. I just want to clear up what that is.
And in this case, as I said, the history is recent because they went back and looked at Bitcoin ETFs. Now, Bitcoin was trading at about $46,000 when a dozen ETFs were launched on January 11th, 2024. Again, this is very recent history. As of this year, on June 30th, Bitcoin trading at 58. So it sounds pretty good, right? You just bought that and the funds made you a lot of money, right?
Mm-hmm. Yeah.
No. Mm-hmm. This is fascinating. In aggregate, the investors in the original cohort of Bitcoin funds lost an average of 5.8% a year.
Okay,
let me say that
pause
again.
there. Yeah, please pause there at that 5.8 because here's people are going, well, wait. Bitcoin made money, went from 45 to 58.
Yep, exactly.
And yet the average investors lost money.
Yep.
We need to explain again, this is because of behavior, not the underlying asset. Buying when it's hot, selling when it's not.
Yeah, and the point is people poured money into this from October 2024 through January 2025 as Bitcoin went straight up to 100,000, 20 billion went into those ETFs. And then when Bitcoin went down, what did people do? Oh, they sold the funds, pulled out $3.5 billion, and then another 50. This happens over and repeat if necessary. From November 2025 through this May, Bitcoin price collapsed. People yanked $6 billion out of those ETFs. The market pulled back. There was aggressive selling. Again, this is something that we have chatted about a lot. And this is not the first time by a long shot And this is something that you need to be aware of because it's simply part of your overall emotional makeup. Don, you kind of tease people at the beginning, but the fact of the matter is, and this happens all the time, I talk to people regularly who say, well, I want to own that because that's been good. And as you point out, you need to own it before
that's
it was
going
good.
up. That's going up. It's a problem with tense. We have a language issue. We confuse our tenses. Nothing is going up. It has only gone up. There is no, when it comes to investing, there is no present tense. None. Because the present, you haven't seen the present yet. You can't see the present in the stock market because there's a delay in the reporting. So what is going up or down right now, you won't know until it's gone up or down soon or a long time from now. I don't know.
Exactly. And so Morningstar does this survey, does this work called Mind the Gap. Now, according to Morningstar, investors leave about 15% a year of potential gains on the table, with investors like making 1.2% less per year than funds they own. By the way, guess where the biggest losses come? Which type of funds do people have a tendency to underproduce? Sector funds, right? I mean, all the junk
because that's all about following trends.
It is. Yeah, these are all great ideas that don't turn out so well. So what about this year? What do you think the money's gone into this year? Well, lots gone into the S&P 500. Okay, because
I think I know the answer.
Pretty good. What, you're raising your hand there in the back, so what do you say?
I say AI.
Yeah, that's been the big theme.
How did I know that?
A fund called DRAM has added $20 billion. Money's poured into South Korea, which is up over 100%, by the way, over the last year.
What does South Korea make a lot of?
Yeah, your guess.
Chips. Taiwan. Chips.
Taiwan, which was like the number 7th largest market in the world, is now number 3 by market capitalization. People have run those up. So again, and I'm laughing, but we discussed this recently about your book too. This is not the first time people piled into what? Technology in 2000 after it had gone up in the late 90s. People piled into real estate in the mid-2000s and the mid-aughts because that went up a lot. This has happened many, many times. But I think there's an easy way to avoid it. You mentioned one thing, which I think is absolutely imperative. You can't mention what's going on today. Everything when it comes to investing has to be past tense. So just something is done so well right to this moment doesn't mean it's going to continue in the future. Part 2, this is so easy to me. The people that have an asset allocation, that is, they have a stock-to-bond ratio, that is, they own the globe when it comes to stocks. They don't face this issue at all because they don't buy and sell. They don't get involved in things that are hot or recent or have to own. They have an asset allocation, not a series of ideas. The people that own Bitcoin ETFs, well, that's a great idea. That's a great narrative, right? And today, the people that are buying South Korea or buying chips, all that stuff, those are ideas. They are not an asset allocation. But if you have to, I think Jason even mentioned this, if you really just have the urge, because we had people calling us about the SpaceX IPO too, and we had to tell them no, which I don't like telling people, but we told a lot of people no, that's a bad idea. Mm-hmm. But if you really have to do it, gosh, and I hate this expression because I don't have it in my life, but I guess you could have play money, some little bit amount that you can put in there and you could get up every morning and watch it. And then the third part for me to fix all this for you is you got to figure out a way to ignore the popular press. All the stuff, if you go to CNBC and Michael Blurry says to own this and Jim Cramer says you got to do this today, those are ideas. Those are not a way to build a correctly balanced portfolio. And that's really where the problem starts. And those are the people that end up buying Bitcoin at the high and then selling it at the low. Repeat, as I said, if necessary.
Again, it pays to be a little counterintuitive and counterlogical because those who try to win generally fail. Those who don't try to win just do as well as the market tend to do a lot better than the aggregate of those who try to win. Yes. There are anecdotal tales of people getting rich on these bets on various stocks and sectors. Absolutely. It happens. But we know it doesn't happen to most. And if you are pursuing that winning strategy that ends up for most being a losing strategy, how are you any different than someone who's addicted to the lottery or going to the casino? How are you any different? You're not. Just because you think you're smarter doesn't make you smarter. Question time here at Talking Real
we've got
Money.
a lot of questions.
We have so many questions.
Thank you, by the way, for doing this.
People responded to
and
your
some of these
entreaties.
are old. I'm going to apologize.
Well, okay, they're not. They were from
May.
right at the beginning of your vacation.
No,
So
some of these go back to May. Remember, we got a big pile that were stuck on somebody's desk or something.
Or stuck in the computer or something.
I don't know where I have no idea how the pipeline works here, but they were there, and I feel bad. So we're trying to get to some of those. So let's go to them. Tia from Long Beach, California says, "Hello, Don and Tom. I enjoy the show. I hope you're. I heard you are light on questions. No, she wrote it correctly. I hear you're light on questions during summer, so I'm finally writing.
You just made a new word.
I heard.
Yeah.
I'm 4 years away from retirement from a public service job. I'll have access to a 403B thanks to the rule of 55, as well as access to the 457. Now, both of these are retirement plans, usually for people in public service types of jobs. Most of the funds in both accounts are pre-tax. Remember, pre-tax money in the 403B, pre-tax money in a 457.
Got it.
Tia says, per my accountant's recommendation, I started doing all Roth contributions this year. So all contributions for the last 4 years will be Roth 457, Roth 403B. I've also maxed out a Roth IRA for 15 years. Wow, good for you, Tia. And I have taxable accounts to fund Roth conversions or whatever else comes up. Here's the part about the planning. My pension will cover basic expenses with a COLA for life. I think that's cost of living increase, not a drink.
I was going to say, either way, it's a good thing.
That's right.
It's refreshing.
Keep it cool in the summer. I'm thinking of withdrawing funds from the 457 pre-tax upon retirement to bridge the gap until Social Security starting at age 70, and for discretionary spending. If I spend some of these pre-tax funds, I'll need fewer Roth conversions. Does it matter? Here's the question. Does it matter if I draw down the 403B or 457 first?
No. It's the same as doing a Roth conversion. It's the same tax bill.
But she then adds, I can also use the taxable accounts, but there are considerable long-term capital gains. Yeah, but those should be at a tax rate lower than what you'd be paying in income tax on the 457 and 403B.
Right. It's a pay eventually scenario either way. You're going to have to pay
in general of taking the money from the taxable first, generally.
Again, generally, because we have to paint in broad strokes for a mass audience. There may be specific reasons why it's better to do something else, but our general rule is for distributions in retirement, start with the taxable account, take those gains because the tax rate is lower. You continue to defer the tax the taxes in the pre-tax accounts, and you continue to let those Roth accounts grow tax-free. So start with the taxable, then to the pre-tax, then to the post-tax. Yep.
And by the way, it doesn't have to be a binary decision. You could do some of each. Again,
isn't that a
situation.
tertiary decision? It's three.
But you could say, I'm going to keep my tax rate at X, whatever it is. I don't know how much your pension, all that kind of thing. So I don't want to mess with it. So I'm going to take a little bit from my pre-tax, a little bit from my
Okay, so you're
taxable.
implying it might be a good idea to do some tax planning in advance.
Got to do it in this case.
Yeah.
Huge decision there.
It's a good piece
says you've
of
got
advice.
an accountant. Accountants tend to look back, not forward, so you may need a planner to do some of the tax planning. But yes, in your case, I think it makes a great deal of sense. But thank you for the great question. Congratulations on your upcoming retirement. 4 years. So like in the last 4 years.
Well, that's about when I'm thinking about mine. 4 years, 4 plus.
Actually, after going on vacation, I think 4 weeks, I get back.
Did you really? Really? You liked it? You worked the whole time.
I know, and I'm just one of those people. It doesn't. If I'm there, I'd rather be here. If I'm here, I'd rather be there. And I got to get over myself. I get it. So
you're like me. You just get bored easily.
I just want.
I get bored, then I go.
Books.
I got to go do another podcast.
Great books too, but they were wonderful. All right, Jeff from Del Rio, Texas. Hey, Don and Tom, I'm a factor believer and doing my best to be a hands-off KISS investor. Does that mean you're affectionate to the people that run the funds, or what's that mean exactly?
No, that's not allowed anymore. You're not allowed to be affectionate to your fund people.
The line is drawn there now.
No, and I don't know what he's kissing, but no, that's keeping it simple, stupid.
You had to tell me that. So I'm sorry, I apologize. He says he's almost completely in AVGE.
Okay,
which is
great.
The Avantis Global Equity Fund. Very good fund.
That's great, even though we don't get a penny from Avantis for saying that.
We're getting to that. That's the next question.
Oh, okay.
So, besides you two and Paul Merriman, I've been listening to Larry Swedrow, and he talks a lot about alternative investments.
Oh, Larry.
I heard you two talk about the drawbacks of private equity, and I'm not interested in Tom's favorite gold or Don's favorite Bitcoin, but rather reinsurance. It seems like the biggest issue is the expense ratio. Can you talk about the pros and cons of investments like reinsurance and the companies like Stone Ridge that offer them? So, okay, but first let's know what reinsurance is.
There's so many places to go with this.
Yeah, okay, but let's talk about what reinsurance is first. Obviously, if you have a policy through a large insurance company, let's just say State Farm, for example, and State Farm has a certain number of reserves, so if something bad happens, they can pay out all the policies, et cetera. However, there is insurance on insurance people may not be aware of. There are companies that insure those companies, et cetera, that go bigger. And you can actually invest in those companies, in those policies. I remember when I first learned about this, 25 years ago, I didn't even know about it. But you can invest in those things. And yes, Stone Ridge, for example, has a reinsurance fund, I believe, of some kind.
Yeah, the Stone Ridge High Yield Reinsurance Risk Premium Fund Class M.
Yeah.
And, okay, let's talk about it for a minute, okay? Let's. I know it's supposed to be a non-correlating asset class.
Yeah, it's different.
It zigs when stocks zag.
Yep.
Well, okay, that's nice. But what's
what
your
happens,
ultimate
what happens
goal?
When the hurricane zigs.
Well, okay, I wasn't even going to get to that one yet. Okay, there's what the biggest risk with reinsurance is that they've calculated all the risk factors. They've done their math. And we get the first Category 7 hurricane that runs from Miami. This is a dystopian movie plot. Okay, it starts in Miami and it runs right along the East Coast, all the way up the coast, and then it along the way it hits all of those little coastal cities, and then it gets to Washington D.C. and Baltimore and New York. And it doesn't just cause billions of dollars of damage, it causes trillions of dollars of damage. Have insurance companies ever been surprised by big bills? Hi, I live in Florida. We're the poster child for that. So that's the biggest risk. But let's just talk about the little risks. Let's just talk about, and this is the stuff that I don't like Larry not addressing more. One, Stone Ridge is one of the few places where you can get one of these funds. The expense ratio, I love seeing Tom blanch at this. You ready?
How much?
1.84%. Woo. Okay, now, if they were making buckets of money, maybe, but even then we would probably say no because we think that a high expense ratio is a real problem. But their 10-year average annual return, and they haven't been around much more than that, is 6.5%. So you're talking about 25% of the fund's return goes to pay for the operation of the fund. And the fund, by the way, has been relatively volatile. So it hasn't been, I mean, it has a low standard deviation like bonds.
What's the payout? Does it have a regular
really
income feature to it?
The problem with Morningstar is they've hidden that now because yields are so complicated these days.
That they are.
Hold on, I'm going to find.
While you're doing that, I guess the other thing to me, Jeff, would be what it's going to replace in your portfolio. In other words, what's it going to hold? Is this going to be the fixed income portion? Is this going to be a stock add-on? Where are you going to position this? What percentage of the portfolio is it going to make up? And
I'm sorry, I've argued this with Larry. I still don't get the why. I truly don't get the why.
We're getting to that, right? Yeah. Again, is this something you really want, or is this something you actually need? Would be my question.
I don't think so. I don't think so. I mean, and here's the thing: here's where the volatility kind of shows up. The 1-year return for this fund has been 14. The 10-year average annual return, though, has been 6.5. So that's a big swing in there, and it shows you've had some years where even this fund has returned. As a matter of fact, from 2017 to 2022, this fund barely got out of its own way. It barely broke
how much is
even.
In it? Is it still small?
Yeah, it's small. Hold on.
Because I think
it's not that small. 4.6 billion.
Is this is something, again, and no offense to any of you, but this is something that sounds like advisors are going to use, and I'm not sure individuals should own this. I just it feels risky to me. I know Larry's going to argue with me, and he'll send me a
Larry
nice
will
note.
argue, but the fact of the matter is I truly do not feel comfortable suggesting anyone put this in their portfolio, one, because of the complexity, but I cannot get past those high fees. I cannot do it.
Almost
We've had
2%.
We've had this argument with some of the other alternative companies out there, and we said, no, we're not using your products. They're too expensive. Well, they're high cost to doing it. Yeah, it sounds
Again, I don't know something that you need.
That's not
That would be my other take. All right, final question from Piqua, Ohio. Fred. After listening to the June 15th, 2026 podcast, I was wondering if you were preparing to start selling annuities for Appella. I'm just going to go ahead and put it right out there. I don't know about Dom, but the answer for me is no. I'm not getting in the annuity business. But I'll let Mr. McDonald answer.
Well,
for himself.
I've been trying to think about a better way to fund my future, and those commissions are pretty darn attractive.
You imagine had we done that?
Had we done
that, we.
Tom, we would be so wealthy. June 5th.
Big mistake. Let me ask you a question while looking it up. Okay, the reason for the question is when you took up the topic, if the two of you were paid for endorsing Avantis, Dimensional, or Vanguard at $14.20 into the podcast. Part of your justification came straight from the annuity playbook. At $19.45 into the podcast, you stated that, quote, we don't get anything from them.
I know where this is going.
Our entire compensation comes from Appella Wealth. And then he goes on. Isn't that what annuities sellers say as well while their company passes the 8 to 10 commission on they receive to the seller? If this is what happens with the funds, Appella and you, I don't believe so, but it just sounded like the sales pitch from the annuity sellers.
It does.
Fred,
that's the problem with denying.
Yeah, exactly.
It sounds
the same pool.
Because so many people deny. It sounds like sort of the political situation where we've got all these guys doing all these bad behaviors on both sides of the aisle. Okay, we just had a Democrat who was an idiot with his personal behavior, and everybody denies. So what's the truth? Well,
we don't get anything from these guys.
We don't. And it sounds like a Shakespearean line that they do protest too much.
Yes,
but the reality is we don't. And I guess the best way to show you that we are sincere is for you to look back at the previous 1,900 and some odd episodes of Talking Real Money and check it out. We tend not to lie. At least we don't lie intentionally. We might make mistakes, but we have a really good long-term track record of tending to tell the truth. Insurance agents don't.
Fred,
yes.
Fred, just trust us, okay?
Oh, yeah. That's what the insurance agents say.
I know. Last time I heard that, I ended up with a new child, a dog, a house I couldn't afford. I've learned my lesson. I'm not buying that anymore. But anyway, so Fred, Thank you for that. It's a great line. We don't get anything from anybody else.
We do protest too much.
Sorry. Exactly. Great question, though. Thank you for listening, and thank you for writing, taking the time.
Thank you for all the questions, and keep sending them in at talkingrealmoney.com on the Ask a Question button, or speak them using the microphone in the lower right-hand corner of that screen, and those end up going. Here's the nice thing about the speaking questions. You know where the answers will be given. They'll be given on the Friday Q&A podcast every single week. And we've been getting a lot of those questions, too. So we're doing – I mean, if they keep coming in at this clip, we could eventually have a 10-question Friday podcast that literally runs for 22 hours.
And then would that make up the whole 4 years and then you're done? Would that be it right there?
No, see, that's the problem. It's not hours. It's the days served. It's time served.
That pretty much says everything you need to know.
And I don't get time off for good behavior either.
It never happens.
So keep sending those in. If you do want to talk with an advisor who will tell you that they don't get a commission, and you're just going to have to trust them.
Fred. Really.
You're just going to have to trust them. If you want to meet with one for free, they're not going to charge you anything. And I know that sounds like a lie, but it isn't.
Just trust us, Fred.
Just go to talkingrealmoney.com and click on Meet an Advisor. You can even meet with Tom, and he's the biggest liar of them all.
Just trust me, Fred. Really, just trust me.
Look, is that a face that would lie to you? Well, good thing you can't see it. It's a podcast.
Not from this guy, but maybe.
All right, take good care of yourselves. We'll talk to you again on the morrow, no, this isn't a Friday. So, We'll talk to you again tomorrow on this podcast channel as we continue our quest to be, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.